is Sunday, July 11th, and this is episode 21 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at what happened last week. All right, you see that we did breach one of the breach points, and it was the lower breach point of 42.87. If you recall from last episode, I did say that I believed that the lower breach point was much more likely to get breached than the upper breach point, the 43.70. And that is in fact what happened. It went down, breached that 42.87 point, and then came right back up within the same day and closed, well above that breach point. But the very next day, on Friday, the market just completely did a reverse and headed back up to make new all-time highs. So that price action there is something we're going to be looking at as we get into the forecast for next week. But let's just take note also that we did close within the expected settlement range of 42.21 to 44.16, and we did stay well above the 41.26 parabolic SAR level. All right, let's take a look at the moving averages. No surprise here yet again, everything is still flashing green on the bullish cycle. Short term, medium term, long term, everything is still green. And now let's get into the forecast for next week. So on the breach points, we are looking at breach points between at 43.06 on the downside and 43.91 on the top side. Odds are 81.31% that we will have a breach of one of those two levels. But unlike last week, where I saw that there was going to be a movement more to the downside, this week, because of Friday's price action, I don't think we can safely say that there's a bias or a leaning more towards the lower breach point or the upper breach point, honestly. The 43.06 and 43.91 at this point are equally viable as targets for that breach. So it's kind of a 50-50 split there. We're going to add in now the expected settlement range for next week. We're expecting the S&P 500 to close between 42.42 and 44.38. And we are looking at a 79.04% chance of that happening. And then we'll add in the parabolic SAR, which is now up to 41.48, which again, if we were to close below that mark, that would be a very bearish indicator, especially since we would be closing below the expected lower settlement limit of 42.42. All right, and let's put this all together into the relative view for next week. See where we are here. So what's interesting is that if you look at the midline of that Bollinger Band, it sits below the lower breach point and above the lower settlement limit. So the way I'm looking at this, just purely from a visual standpoint, is that we can go down if we were to breach that 43.06, and maybe that midline of the Bollinger Band would provide some kind of support and then bounce it back up into the range above 43.06, or at least staying above 42.42. So it might provide enough support to slow down any downward movement to still close between 42.42. Now, it doesn't mean that's exactly how it's going to happen, but combining all these factors together, I think that's the narrative that I would be expecting to play out, absent some, mitigating factor or something that happens quite unexpectedly. All right, and we're going to move into didn't see that one coming. All right, so did we see all-time highs being made on Friday? Did you see it coming? I didn't see it coming, which sounds kind of weird, right? Because we keep having this situation where we're almost expecting this market to go down. I know I am, and yet it continues to defy what some may call a conventional logic. And believe me, I get the contrarian argument. I get the fact that when people think or they're expecting it to go down, that it takes a while before that sentiment really has any impact. It can't just say, oh, I think it's overbought and so it's going to go down. In fact, some people make a lot of money going against that common perception of what the market should do. So at this point, I had a conversation with a good friend of mine, and we were discussing the fact that eventually markets roll over. Eventually they're going to have their cycles. Eventually, this is going to come down. But rather than trading off of that, we need to make sure that we're putting risk management, that we're putting, money management principles ahead of our sentiment, ahead of what we believe is going to happen. And so even if that means scaling down on some of your trades, even if that means, modifying your strategy or your approach, you can still maintain and hold an opinion, and you could be right. But just because you're right doesn't mean that it's something that you should influence your trading, because maybe it's just not the right time. So that's something to keep in mind there. And we'll wrap up with the quote of the week, which this week is by Mr. Peter Lynch. And he says, in this business, if you're good, you're right 6 out of 10. You're never going to be right 9 times out of 10. Now, it makes sense, right? Because nobody's perfect. But what I find really, really interesting about this quote is that he could have easily said that if you're good, you'd be right 6 out of 10. And if you're, but that you're never going to be right 10 times out of 10. He intentionally chose to say, you're never going to be right 9 times out of 10. Why is that? Now, I believe that what Mr. Lynch was getting at was that being right 10 out of 10 times shouldn't even be an option in your mind, shouldn't even be on the table. It shouldn't even be part of the discussion, because at that point, you're striving for something that could be more self-destructive than anything else, and that's perfection. And so I think that perfection in terms of being right every single time is a very dangerous goal to have, because it's going to inevitably set you up for failure, which then can trickle down and affect your performance and a wealth of other things. So I think that he chose that 9 out of 10 times to show that even if you were well above being really good in this industry, 9 out of 10 is still kind of like that upper bar. So just a little something I kind of gleaned from this quote here. And, it's interesting because we see numbers being thrown out in this series of episodes that I've been putting out, where we're looking at 70%, 80%. Every once in a while we'll get something that's 90%. And even when I had something that historically had occurred 100% of the times, if you remember, I said we're going to knock it down to like a 99%, because I don't believe that we should ever assume that something is going to happen 100% of the time, or that we could ever do something 100% of the time. Take that for what it's worth, and hope you guys have a great week trading. See what's going on in the markets. It's hot out there. The market's hot. Do with it what you will. Take care, guys. I'll see you guys next week.